Clay Patton on the Rural Radio Network. Let's take a rundown of what's happened in a wild week of trading here with Darrell Holaday Country Futures, Frankfort, Kansas. And Darrell, I think wild is an understatement here, as it has been a very volatile week. We've gotten out inflationary data. We've gotten out WASDE data for the crops. I guess where's the best place to start on eating an elephant of what has been a big week in the trade?
Yeah, it is. It has been, once again, we started the week on the grain side. Of course, we were coming off of a very strong week off the crude oil because of the OPEC cut last week, but the crude oil in the end was down $7 this week. So we turn around and add 13, take 7 off. And in the backdrop, a person needs to remember that did affect grains. But really, we had a lot of volatility, a lot of strength early in the week on the corn and the wheat, right out of the chute Sunday night into Monday. Concerns about Russian-Ukraine situation, that tension again surfaces again. And as we came to the end of that, it's interesting when you kind of go full circle. Started out with this concern, and then we had the USDA numbers. We'll get to those in a second, but on the back end of that, on that issue, on the Russian-Ukraine, indication maybe Friday that we're going to see the corridor stay open. At least there's no sign that it's going to quit November 22nd. They're trying to negotiate. Putin's stance is he wants to see the grain out of Ukraine go to poor countries, not just countries that have money. It's because it's supposed to be a humanitarian thing. Well, the problem is what he wants is that Ukraine's wheat to go to the countries that have no money, and his wheat to go to the ones that do. It's kind of a difficult stance to justify if you think about it. And at the same time, he needs that Black Sea to stay open. We got to remember as we get into the winter, he's going to need that area south of Crimea, or he won't. His ability to export is very limited. So I think that kind of is where we ended the week, that it doesn't look like it's coming to an end anytime soon. At the same time, neither is the Russian-Ukraine war coming to us anytime soon. So that was kind of the backdrop. Once again, that was the strength early, and then we got ready for those USDA numbers that came out on Wednesday, which is big numbers, but yield numbers and production numbers and new WASDEs, and they made a lot of adjustments. Corn yield was adjusted down half a bushel to 171.9. They also adjusted in the WASDE several of the use numbers to adjust for the stocks number that came out September 30 and the lower and the lower production. But basically, in the end, they ended up 1.179 billion bushels in stocked, up near the 1.2 billion, about where we were last month. That's the type of movement they're going to make. For one, that was easy for them to adjust the export projection, and because it needs to come down. We'll talk more about that here in a second. So that took care of the corn, and the corn kind of went both ways. It broke hard on the numbers, then it rallied, but it really couldn't hold. Once again, the overall weakness that we saw in the other markets of issue too. Soybean yield was dropped 0.7, pushed the acre to 49.8. Now that was seen as friendly, but the interesting side of that is the high off of the report occurred in the first 3 minutes right after the report. By 11:02 or 3, we had the high end, and we traded lower throughout the rest of the week because most people did expect those to come down. When you look at the corn and soybean yield numbers that came out of the NASS numbers on Wednesday, they basically did this. They went into the Midwest and made them steady to better. For example, they moved the corn yield in Illinois from 204 to 210, which matches their record. On the other hand, they just hammered Nebraska and Kansas yields and everything out here, just pushed them lower. Same general trend occurred on the soybean yield, that generally the weaker yields were seen in the West, at least the Midwest holding steady with where they were in September. But once again, the other common theme is they lowered the export projections in all these markets. Lower soybean export projections, they lowered the wheat export projections, and the corn, they lowered it 125 million bushels, which sounds like a lot. But the reality is the pace we're going right now, they're still too high, because the corn market structure in the U.S. is going to limit the export potential. Sometimes we don't stand back and go, wait a minute, it shouldn't be any big story. You're sitting here seeing record basis levels in the plains. They need corn. We need corn. It's going to attract corn right out of the Midwest. So those basis levels get factored back into the Midwest, and therefore those have to be factored in if somebody wants to offer corn at the Gulf or the PNW for export. So if it's worth $1.80 to $2 over in Dodge City, what's it worth at the Gulf? Well, it isn't worth 50 over. We all know that. And so the reality is that's where the corn goes for a while. And then you throw in the lower river levels, it makes the Gulf even more expensive because of the fact that transportation costs go up. That is all. So that is the structure that is limiting the exports. Is going to continue to be there because the demand is in the front end of this market, in the interior market. That may change as the year goes on, but right now that's strictly the dynamic. We're seeing the same thing generally in the wheat, but a little different story in that the U.S. wheat is just simply well above world wheat prices. And the soybean side, got this, once again, the same thing. Brazil continues to be the lower price, but we did see some export business this week show up in the daily export report with about 1 million tons being sold. So that's worth noting. I think we got prices down to levels that were certainly attractive. Then you throw all that in with the backdrop of a CPI that comes out with 8.2% increase in inflation, and that came out on Thursday morning, and then you have the equity market fall completely apart, only to rally back and 700-800 higher, and then turn around and be weaker on Friday. So the grain markets had to deal with all that, and all the commodity markets. So once again, on the export side, the soybean market is the most competitive. Corn and wheat are well below, or priced well above the world prices, and that continues to hurt the export market. On the other hand, the November crude oil down $7.03 at 85.61. That pressures ethanol. It's worth noting still in the last 3 or 4 weeks, we continue to use less gasoline than we did on a week-to-week basis, or let's say the steady to below the 2020 level. When you think about October 2020 and the COVID situation, September, that we're actually using a little less gasoline, that would tell you that some of the slow factors that we're seeing in the economy. On the week, December corn up 8 cents at 6.91. March corn up 5 at 6.96. November soybeans 13.84 at 14. January beans up 14 at 13.93. December Kansas City wheat down 17 on the week at 9.52. That's after going up above 10.30. July Kansas City wheat closed at 9.40, down 11. Once again, that's after a high of basically near 10.10 on the week on the new crop. So that's quite a reversal after being higher early in the week and midweek. November, as we said, November crude down 7.03 at 85.61. On the livestock side, we were higher in all the cash fundamentals for the hogs and the cattle. The future was somewhat mixed in cattle, but higher in the hogs, significantly higher in the hogs, as the cash trade in the cattle was higher at 1 to 2 higher, but packers are working their strategy in the South. They've now convinced a lot of cash sellers to go to bid to grid so they can keep those bids low enough to give them a base price, and they don't have to report what the net price or value of those cattle really are. They continue to chase those higher quality fed cattle supplies. They do that on the South just to try to keep their captive supply base formula rates low enough. It helps them, and that's the whole strategy, and they're doing it. Hog index holding up well near that $90 level. We still anticipate we'll see some seasonal increases over the next month in supplies that will push the prices lower, but you've got to like the way that the index has held up quite well at that $90 area on this price break, and the futures recognize that by adding taking a lot of the discount in the December hogs out this week. October cattle 146.95 up $1.62 on the week. The December cattle, though, down 27 at 148.05. October feeders 173.80 down 92. November feeders down 85 at 174.77. Once again, the deferred cattle futures being lower made it difficult for the feeders to rally, but still held in with under $1 loss. October hogs 93.37 up 42 on the week. December hogs up 5.10 on the week, closing at 82.25.
And that is Darrell Holaday with Country Futures, Frankfort, Kansas. Learn more anytime at countryfutures.com. Again, recap this whole program when you check it out at ruralradionetwork.com. Do remember trading futures and options involve risk of loss, may not be suitable for all investors. Do consider these risks before investing.